A debt trap disguised as a deal. Store credit cards are one of the most deceptive financial products available in the US. And in 2025, they've only become more dangerous. They promise upfront discounts, cashback offers, or member-only perks. But the real cost comes later. Crippling interest rates, hidden fees, and long-term damage to your financial health. What are store credit cards? Store credit cards are lines of credit issued by retail stores like Macy's, Best Buy, Amazon, or Home Depot that can typically be used only at those specific stores. They are marketed as easy-to-approve options, especially to younger adults and shoppers with average credit scores. In 2025, stores are aggressively pushing these cards due to declining foot traffic and rising e-commerce competition. However, behind the flashy offers are financial terms that most consumers don't read, and that's where the trap is set. Sky-high interest rates. According to the Consumer Financial Protection Bureau, CFPB, the average APR on store cards in 2025 is between 28 to 33%. This is 10 to 15% higher than traditional credit cards. Here's what that means practically. A $1,000 purchase you don't pay off immediately can balloon into $1,400 to $1,500 within 12 months. Even minimum payments often don't touch the principal, causing debts to linger and grow. These interest rates are worse than some payday loans, especially if you miss a payment or get hit with penalty APRs, often as high as 35%. Deferred interest scams. Many store cards offer 0% interest for 12 months promotions. But here's the catch. If you don't pay off the entire balance before the promo ends, you'll be charged retroactive interest from the day of the purchase. It's a trap thousands fall into every year. You buy a $2,000 TV on a 12-month promo plan. After 12 months, you still owe $200. Suddenly, the store adds $400 to $500 in back interest because the balance wasn't paid in full. Impact on credit score. Store cards often have low credit limits and high utilization rates, which can negatively affect your credit score. They also increase your total number of accounts, shortening your average credit age. Spike your debt-to-limit ratio if not paid off immediately. Attract hard inquiries, especially if you sign up frequently at multiple stores. Emotional spending trigger. Retailers often train staff to pitch these cards at the checkout counter, preying on impulse decisions. Many shoppers sign up without understanding the terms, and once the line of credit is open, it becomes easier to overspend just to use the discount. You end up buying more often, and justifying purchases because you saved 15%. Smarter alternatives in 2025. Use a low-interest, cash-back card like the Chase Freedom Flex or Citi Double Cash, which offers real rewards and wide usage. Installment options via Klarna or Affirm offer better transparency and no retroactive interest if used wisely. Use debit card tools like Acorns or Chime, which round up your purchases and invest the difference. Store credit cards aren't a tool for saving. They're a corporate strategy to keep you spending and stuck in debt. If you're working toward financial independence in 2025, avoid these shiny plastic traps. They hurt your wallet, your credit score, and your peace of mind. 3. Oversized homes, when more space means less wealth. In 2025, the dream of a massive house with multiple bedrooms, a home theater, and a 3-car garage still appeals to many Americans. However, oversized homes, those far beyond a person or family's actual living needs, are silently sabotaging financial freedom. They're not just expensive to buy, they're exponentially expensive to keep. In today's inflation-heavy, high-interest environment, the costs are worse than ever. The myth of home as an investment. For decades, owning a big house was considered the ultimate sign of success. Many still believe a home is an asset that appreciates over time. But here's the truth. Your primary residence is not an income-producing asset unless it's rented out or monetized. If you're just living in it, it's a liability, especially when it's oversized. In 2025, due to ongoing inflation, interest rates, and housing supply shifts, the cost of owning and maintaining a large home is higher than ever. The hidden costs of big homes. Let's break it down. Mortgage. A larger home means a bigger loan. And with average U.S. mortgage rates now hovering around 6.5% to 7.25%, that means tens of thousands more in interest over the life of your loan. Property taxes. These are directly tied to the value and size of your home. On average, taxes on a $600,000 home in high-tax states, like New Jersey or Illinois, can exceed $10,000 to $15,000 per year. Utilities. Heating, cooling, lighting, and cleaning a 4,000+ square foot home costs significantly more than a modest 1,800 to 2,000 square foot house. Energy bills alone can be $300 to $500 per month higher, depending on location and season. Repairs and maintenance. According to the 2025 Home Advisor Survey, Americans spend around 1% to 3% of their home's value annually on upkeep. That's $6,000 to $18,000 per year for a $600,000 home. Furnishing costs. The more rooms you have, the more furniture you need. People often go into debt just to decorate empty spaces they don't use. Lifestyle inflation. Larger homes are usually in higher income neighborhoods. Psychological and emotional impact. Oversized homes often provide short-term ego boosts, but long-term stress. Homeowners may feel pressure to keep up appearances, pay off large debts, or overwork to manage the mortgage. Instead of freedom, the big home becomes a burden, a financial prison with nice hardwood floors.